Okay, let's chat with James and Luke.
Welcome everybody to Let's Chat, the podcast brought to you by Property and Poppadoms. I'm James Rogers and I am the founder of Property and Poppadoms, and I'm here today with my co-host Luke Biddle.
Hello.
So we've got another fantastic guest today, but we'll introduce him in a moment. But firstly, we're just going to cover our sponsors. So Luke, if you'd like to kick that off.
I would love to. If you've got to 2026 and you're in property and you are not using digital technology to find and source your deals, then you are missing a trick. And I would encourage you to catch up. And our sponsor today is Property Filter, who have an amazing array of tools to help you to make easy work of finding your next deal, making sure that it fits your exact criteria and your deal box to the letter. So check it out at Property Filter. Absolutely fantastic. Who else have we got, James?
So once you found your deals on Property Filter, you're obviously going to need to get them funded. So Roma Finance, they can help you do that. So they offer short-term and term debt facilities to enable you to do so. They've also just released a number of new products. One of those is they're now funding deals in Scotland. So they're able to finance those now, and that is a real significant development in their lending scope. And also we have 978 Finance as well. So those guys can also arrange term debt for you through intermediary-led lenders. So if you need Roma to finance your short-term facilities, then 978 can exit you as well. So you've got a couple of options there. And that leads us seamlessly onto our next guest. We're very excited to have him in today. We've got Mr. Scott Marshall from Roma Finance. Welcome, sir.
Thanks very much indeed. Lovely to be here.
Good stuff. So I think if we kick off, if we sort of start off a little bit about yourself, you know, what led you up to starting Roma? How did that look like? What were the scenarios and situations you found yourself in that led up to that point?
You know, I always say that Roma wasn't built in a day, and I think it's 100% true. Let's start off with a bit of humour. But essentially, I was working. My background is engineering, then into finance. Where I was a corporate financier. So I've had a number of kind of things that have happened to me that have been unlucky. So went into the family business, which was engineering, got made, well, the business went into receivership after 53 years in business with my father, my grandfather. Then I joined a firm called Arthur Anderson, where I was training to be a corporate financier. Enron happened. I got that business obviously went. Then I went to the firm that's now known as Together, as a kind of trainee to go around the sort of different departments within what's now Together. My first secondment was in underwriting, and I kind of went. I never left that department, so I went from trainee to underwriter to senior underwriter, head of underwriting, and credit and risk director in a space of about 3 years. And then, of course, the credit crunch happened. Another piece of bad luck. Got made redundant there, and I was like, had 3 kids to support. So it was like, well, I can't continue this. I've got to have a contingency. And at that time, there were no jobs in underwriting in financial services at all. They were like as rare as rocking horse poo. So I got a job in IT, but there was a startup lender called Octopus Real Estate, and it was basically one guy and a secretary, and they needed their deals to be underwritten. So Roma was born originally as a subcontract underwriting service for other lenders. Its biggest client was the business that's now known as Octopus Real Estate. But what that did is it allowed me to keep my hand in the industry. I didn't want to move to London. They were building a team down in London. I'm Manchester-based. And so as they built their team, so the work for Roma dried up. And I was like, well, what do I do with this business? And I thought to myself, well, I've been, an underwriter at what's now Together for 6 years. Roma was underwriting the business for Octopus Real Estate, that's now is, for nearly 2 years. So, well, I want to have a go myself. So, lunchtimes, I get in my car, drive around a corner, phone my old broker contacts. Can I have a deal? Can I have a deal? Most people told me to have sex and travel, which is a polite way of putting it. But eventually, after about 3 months, I got a deal. And cutting a very long story short, this is maybe a conversation for a beer one day. I took equity out of my own home to fund that first loan. It was £75,000. That loan funded on the 15th of December 2010, and Roma as a lender was born. It took me 3 or 4 years of running this business as a side hustle because I had a day job in IT, believe it or not. I took on my first member of staff on the 2nd of January 2014. I couldn't afford to pay wages to me and to him, so I paid his wages before I paid myself. So between effectively December 2008, when I formed Roma, and the 1st of October 2014, when I joined it as its second employee, I didn't take a wage. So 5 years worth of sweat equity building that business. And so when I joke to say Roma wasn't built in a day, absolutely it wasn't. You know, building a business is never the get rich quick scheme. It never is. Actually, what you've got to do is have the right behaviours in the right way. And look, I've always thought that, and this is core to Roma's strategy. What some lenders in the short-term lending space in particular, they see how much profit can I make from this transaction, okay? Whereas I've always seen what is the value in a relationship, because if you treat a customer properly, then they leave you with a good taste in their mouth when they've finished borrowing, they will come back to you for the second time, and they'll also recommend their network to come and work with you. Okay, so I've always taken the long view in terms of building this business. And that really kind of cuts to the core of what Roma is all about, which is this business exists to lend people money that are either adding value to a property or deriving an income from property. Okay, so while we launched into the short-term lending space in essentially 2014, when my first colleague joined, even though we'd done a handful of loans really before then, we really kind of got going on January 2014. We've always taken the view that any good business, any sustainable business, it's all about creating sticky, long-term relationships with good customers. Whatever business you're in, that's got to be what your business is about. And so it was all about how can we monetize sticky long-term relationships with products that support our customers through their property journey. Okay, so you start off with short-term lending, but as you were saying in the introduction, ultimately once a short-term loan, customer's done their project or whatever needs to be done, a refurb, their development, whatever, we've got a really thick underwriting file. Well, that customer, we've funded the risk on that asset whilst the customer's doing that project. But another lender is benefiting because they're doing long-term finance. So in March 2019, we launched what we call the Customer for Life proposition, which is where we also do longer-term lending. So we launched initially with 5-year buy-to-let mortgages in March 2019. And the idea was that a customer, when they have finished their property project, they have the choice to either exit elsewhere and release the equity they've created, or exit onto a Roma product. Okay, and because they're exiting onto a Roma product, what that does, we can move them from a bridge onto a buy-to-let in the space of about a week. Okay, same valuer. We know the customer, we know the property, we know the asset, we know the project, and it's seamless. So we can use the same valuer, we can dual rep the exit process. So it might take, and I know that there's all sorts of issues in the system at the moment, but it can take 4 to 8 months sometimes to get a buy-to-let over the line. Roma can do it in a week.
Okay, and that's a huge value proposition there.
Massive. And so the piece around longer-term lending, we launched that in England and Wales in 2019, and we saw that as both an offensive strategy and a defensive strategy. Offensive strategy, not to offend anybody, but an offensive strategy because it was a way of us growing our business and creating those sticky long-term relationships with great customers, giving them a guaranteed exit almost for the bridging that they went into. But also it was a defensive strategy because if ever the money markets closed, we knew that our customers would not be stuck on expensive short-term loans because we could exit them ourselves. And lo and behold, March 2020, COVID, the money markets closed. We built our short-term lending book, our longer-term lending book on the back of that. Number one, outbreak of the war in Ukraine, money markets closed. We carried on building our longer-term lending business. And so, that builds trust, it builds loyalty, and it builds certainty for good customers where they want to come back for more. And when we kind of analyse what is important to a customer, there are really 5 things, and I'm sure that Adam and many other people in the property space will testify to this, that actually there are 5 things that a buyer looks for when they're buying debt. And price is obviously one of those things, but we know that price is not the most important thing. Otherwise, the high street would get all the business and people would wait. Speed is very important, relationships, certainty, and deliverability. And so if you can deliverability, if you can satisfy the other 4 things, you can build a business not necessarily being the cheapest in the market. I mean, there is a reason why not everybody drives Datchas and people drive Daimlers. It's because of the experience that people have making that drive, because both cars will get you from A to B, probably in the same amount of time as well. It's the experience. And so what we've tried to build is a business where that people enjoy. So people enjoy working with us. So we've tried to become an aspirational business that people want to work with, and an inspirational business that people want to work for.
Nice. I mean, just listening to that, because it's not the typical response in terms of strategic direction for a financing company, but it sounds very much like you're focused on customer centricity.
Yep.
And, when I think of that, I think of Amazon. And the reason why we all use Amazon is because it's speed, it's certainty, it's convenience, it's price, it's all of those things. It's more friction for me to find a product that I could buy on Amazon somewhere else, so I become less price sensitive. And it sounds like that's the kind of model that you're building at Roma.
It's very important to be in the mix. You've got to be. There's no point in being the most expensive, because not everybody can afford to go and drive the Daimler or the Brabus or whatever it is. But the reality is, as long as you are in the mix on price, if you can tick the other boxes for everybody else, you can build a really strong, successful business and build trust, because this is a two-way thing. So, when a buyer is making that buying decision, they've got to have a warm feeling about who it is that they're transacting with. And interestingly, bad news tends to travel faster than good news. And so what we've done is we've grown our business organically. And the idea is that actually, we've got customers that have been working with us for 12 years or more now, because of it's a relationship that is, people do business with people. And it's interesting, I'm sure we'll touch on, the challenges, the opportunities within the market for 2026. Technology and AI are both a challenge and opportunity. But what people are obviously scared of how it'll impact their jobs. But the reality is, what it's likely to do is free up people's time to be able to spend more time building relationships with great customers. And that's the thing that people forget, is that every business owner is saying, how can I get more customers? How can I get more customers? Believe it or not, the lowest hanging fruit is a customer you've already got. So what can you do to keep that customer? The hardest business to win is the customer you've just lost. Okay, so what can you do to keep a customer with you and in your business for longer? You've got to treat them with respect. You've got to bend over. A customer is a king or queen. We say in our business that when you come to work, you've got to treat every customer like they are your grandma or your grandpa. And how would you want them to be treated if they were your grandma or your grandpa? And the only time that you don't is when they don't treat you like you're their grandson or their granddaughter.
It's a great analogy. And I, from personally dealing with Roma, I like the customer or borrower led ethos that that you embody at Roma Finance. And we've got certain lenders that are almost willing you and wanting you to go over term. And whereas you guys, you're very open, you're very flexible, and you're able to have a conversation about that and be reasonable as well. And I think that's, encourages that relationship formation that you speak so passionately about. Yep. I think now we've covered Roma, yep. And how it started and where we are today. I'd like to now get into 2026 yep. and what risk and opportunity that you envisage.
Yeah, just one more thing, if I can,
Yeah,
just touch
absolutely.
on what we were talking about, which is that we've got a number of products in our stable now. Okay, and development finance is one of them, bridging finance is another one of them, buy-to-let mortgages is another one, and we'll launch other longer-term finance products this year. But when we move a customer from a dev loan onto a bridge, when it's eligible to be a bridge, not just development, when it's wind and watertight, okay, we save money because it's cheaper debt for us, okay, cheaper funding line. We pass some of that saving onto our customers. Okay, so they've got a warm taste of working with us, and that is how you build, long-term relationships. Is by treating the customer with respect, and it's really important to us.
I mean, something you said there reminded me of, I can't remember his name now. I think it's Mark Shea, who was the founder of Zappos. And his whole philosophy was about delivering excellence and customer care and treating people as though they're a member of your family,
100%.
rather than, being about profitability or being about, improvement. It's just about treating people like family. And I can see how a debt for life philosophy, if you can provide the convenience and if you can provide the relationship, and you're not overextending in terms of your pricing, then why would people ever leave?
Who is it that is paying our wages? It's our borrowers that are paying our wages. And so many lenders forget that.
So 2026 then, let's get on to that then. What value as a market gazer, I'll say that, in terms of finance, what are the markets up to in 2026, and how are you going to be responding in terms of your products so that people can get value both in terms of their investment decisions and in terms of working with you?
Okay, so I think the first thing to say is there's never been a more exciting time to be in this business and in this industry. Lots of people are talking about buy-to-let landlords exiting the market, and yes, there are some exiting the market. The smaller landlords are tending to exit the market because it's more difficult, it's more expensive, capital growth isn't there, and it's harder to make money from a single-family unit. The professional landlords, or the landlords with a bigger portfolio, really see this as a buying opportunity. Okay, there isn't a huge amount of distress, but there is definitely stress in the market at the moment. And when there is a time when you're in a counter-cyclical environment, and Main Street is selling, that is the time when Wall Street buys. Okay, and you've really kind of got this environment at the moment where people are just saying, "I've had enough, can't see it, think it's over," and they're looking to sell. The higher value assets are certainly struggling at the moment. We see that. Wealth taxes are having a big impact. Higher interest rates are having a big impact because mortgages on high value properties, when you have to borrow more, become a lot more, inordinately more expensive. So we're seeing that higher value assets are struggling, but lower value assets are almost an asset class in their own right, like gold, for example. Okay, and so we are seeing a huge amount of transactions in a lower value space right now, because people are still wanting to get into property. Property will never go away. The fundamentals of the property market, where there are not enough properties for too many people, okay, that is only going one way, because we've got people that are, kids are living at home for longer because they can't afford to get on the ladder. There's more immigration coming into the UK. There's more divorces. People are living longer, wanting to stay in their home for longer. And people, because of the way that stamp duty works, people are not trading down in the way that they'd be trading down in previous years. So there's a kind of a real, almost like a pig in the pipe in terms of the property market, where you've just got a huge volume of transactions and opportunities on the lower value properties. And by lower value, it depends obviously where you live, but generally speaking, properties that are less than £1 million are selling well still, okay, depending on part of the country, but they tend to be selling well. Properties over £1.5 million, those properties tend to be more vulnerable, particularly because of the two things that I've talked about. So that's number one. Number two, I think there is a shift away from just doing lending on residential property. So if I look at the business that we wrote last year, more and more landlords are dabbling into commercial. Why? Because first of all, with commercial, you get full repairing and insuring leases. So therefore, the tenants themselves are responsible for looking after your property, number one. Number two, you get tax relief on the mortgage payments that you make on a commercial property if you own them in your own personal name, that you don't on residential. And number three, it's more hands-off in terms of an investment, because the leases tend to be for longer and the tenants have to fix their own issues. And I suppose number four is that because in so many cases the occupiers of commercial property tend to be business owners themselves, that's how they make a living. And because it is easier to evict a commercial tenant than it is a residential tenant, they were, and business owners and occupiers of property know that, they would rather pay the rent on a commercial unit or rather pay the mortgage on a commercial unit ahead of other debts that they might have if they're struggling for cash flow. So it's a more certain market. So we saw a shift on our short-term book last year to do more commercial, more semi-commercial. I think we're going to continue to see that trend this year, and we will be launching products during the year that will support people with longer-term products that can support that market as well. So that customer for life concept, where we can take a customer from a dev loan to a bridge to a buy-to-let mortgage and beyond, we're looking to do exactly the same thing on commercial. So a customer can join us for just a development loan, they can join us for just a bridging loan, they can join us for just a buy-to-let mortgage or just potentially a commercial mortgage, or, as I've said, we can cycle them through those different products. And once they've completed their project successfully, the long-term stuff allows them to release the equity they've created and use that cash to go again on the next product. And so it's all around for how do we support our good customers with better products? From our perspective is how do we support them doing that, but how we're going to monetize even further sticky long-term relationships with great customers as they go on a property journey.
So you've mentioned obviously your products and your offerings and some risk and opportunity there. What does the lending landscape look like in terms of rate and cost to the borrower, and how do you see that sort of shaping in and throughout 2026?
Yeah. So there are global issues at play here, and there's also UK PLC issues at play. Let me first of all deal with the global stuff. We are at a time of immense uncertainty at the moment, and we really have been dealing with material uncertainty ever since COVID, and even potentially before that with Brexit. But let's just assume the start was COVID. The world is definitely a more uncertain world. However, there is the real potential that if there is regime change in Venezuela and if there is regime change in Iran, those are two of the world's largest oil reserves in each one of those two countries. Okay, and you can see that as a result of those two countries having regime change and being more Western focused rather than maybe Russia, China, etc. focused, then we'll see that there's a more stable global environment. We will see oil prices come down. We will see all sorts of challenges that we've seen over the past 2 or 3 years start to ease, and that will really present, we'll see a weaker Russia, we'll see a weaker China, and that will really present opportunities for the entire global, the Western world anyway, opportunities to see our global economy grow with, like I said, cheaper oil prices, potentially, and hopefully peace in the Middle East as well. It's actually a very interesting, we're living through history at the moment. No one knows which way it's going to go, but if it goes the way that I think we all want it to go, or the vast majority of people want it to go, I see it as a huge positive, and the opportunities for global peace and global stability will be very much there. If I now look at the UK's got its own separate challenges, and some of the challenges in the UK actually are self-inflicted, certainly recently. So I'd argue that the government is the wrong side of the Laffer curve in terms of its tax take at the moment. And what that means is there is an optimal amount of tax that a government should be collecting from individuals and businesses. And roughly, according to Arthur Laffer, that's at about 33% of income. Okay, we've gone beyond that. The tax take at the moment is the highest tax take it's ever been even post the Second World War. And you do not grow an economy by taking money out of people's pockets. You grow an economy by putting money into people's pockets and encouraging them to spend. Because when you take money out of their pockets, they don't know what other money you're going to take, and they have an aversion to spending. Okay? And actually, it is not, it is the, by giving people the confidence to go and spend, once they do start spending, that's where all the growth actually comes from. You know, I can go further about how, you know, the top 1% of earners pay, you know, 30% of tax. The top 10% of earners pay over 60% of all tax. You're kind of playing around the edges. There's got to be a much fairer tax system so that actually so that everyone knows where they stand. Because right now, the tax take is so high that people are finding ways to mitigate and to avoid paying tax. For example, moving abroad. Okay, that's not great that we're losing wealthy people overseas. We should be encouraging those people to invest in this country. So, from a UK perspective, actually, it's not great. And as a result of that, I see that interest rates are going to have to continue to come down. Okay, because the tax revenues are not going to meet the expectations of what the government had expected, and therefore that feeds back into the narrative around the lower value properties. Okay, because higher value properties, less demand for them, increasing population, lower value properties are an asset class in their own right. Now, having said all of that, the UK is in a very unique position, a really unique position. I'm going to argue against myself a little bit here, if I can, which is that the UK, for the first time in 5 or 6 years, has got political stability. The UK is seen from overseas as a bastion of A, political stability, and B, economic stability. And it's seen as a great place to invest. So as a result of the instability in the US, as a result of instability in the Middle East, as a result of instability potentially in the Far East, we will see that people will want to invest in the UK. Okay, we're already seeing that neobanks, challenger banks are getting investment, and banks are doing well. We've seen that Shawbrook share prices continue to do well post their flotation. I think it actually is an incredibly exciting time to be investing long term in the UK. So short term pain, long term gain, and potentially global stability.
So what does that mean for UK investors in 2026 then? Great that we've got lots of opportunity for overseas investment, but what does that mean? Does that mean that the market in the UK becomes more crowded and more competitive in terms of investing? And what should UK investors be doing in order to mitigate that for success?
So the other thing to think about is the currency, because I think for overseas investors, you look at the currency. So we've had a weak currency for some time. Okay, interest rates kind of seem to, certainly since COVID, have kind of gone in lockstep with the rate of the Fed. So one thing to look at is where is the Fed's rate actually going? Okay, and albeit that they're far more self-sufficient with natural reserves than we are in the UK. I see that because we have a weak currency and we are an attractive place for overseas investors, now is a fantastic time to buy. A really fantastic time to buy, because actually I see that with interest rates coming down, and they're going to have to fall further because of the issues that I've talked about around the tax take, okay, to stimulate the economy. If people don't buy now, I think that we're going to see actually growth in capital values over the medium term. Does that make sense?
Yeah, absolutely. And obviously you've highlighted an opportunity of significance. I'd sort of go back to the rate. What do you think? And obviously, I'm not going to hold you to it. We don't expect your product range to change, off the back of today. But what do you think that actual cost to the borrower is going to look like on short term and term debt?
Yeah. So if let's look at short term first of all. We've never had a more competitive short-term lending market. Ultimately, that benefits borrowers because increased competition leads to better products and should lead to better behaviour as well, all being well. So I think that from a borrower's perspective, it is a great time to borrow because there's increased competition amongst lenders. On the longer term stuff, which is essentially more sort of feeding into interest rates, I think base rate will have to continue to come down in order to stimulate the economy in the short term. So base rate now, currently as we record this podcast, is 3.75%. As economic data worsens, which is going to worsen, we've not yet seen what Christmas trading actually in reals actually look like. I think that we'll see that base rate will continue to come down. It wouldn't surprise me if base rate is 3% or below by the end of this year. And because there's going to be a falling base rate, so swap curves are also going to reduce, which means that fixed rates are going to come down, which means longer term borrowing costs also will come down. Because there are landlords exiting the space, and some of those properties are going to be repurposed into private homes. There's going to be the shortage of rental properties, I think, is going to continue. So rental yields, even though they've been coming down a little bit recently, I think they're going to be relatively stable. So actually, where you've got rental income stable, you've got borrowing costs going down, it widens margins for investors, particularly investors that can buy well. And now is a great time to buy.
And what's your prediction on capital growth in the markets then? Because Adam talked about his beliefs.
Okay.
I won't cite him, but I'm curious to know what your beliefs are about what capital growth is going to look like in the UK market.
So if we look back at where we were 4 or 5 years ago, okay, we were at a time when base rate was going up. It peaked, and so base rate always goes up faster and comes down more slowly than people expect. It just happens. That way. I think that in the short term we will see a flat market, but in the longer term we will see a rising market, and medium term and long term. And the reason why I say that is because wages are materially higher than they were in 2019. Number one, base rate is now materially lower than it was in August 2023. So therefore I see, and also unemployment plays a significant role in where base rate goes, because and I expect that we will continue to see this, if businesses are struggling and laying people off, which we are seeing, and unemployment starts to go up, the other reason why the central bank will have to reduce base rate here is to stimulate the economy and stimulate investment. And so I actually think that short term we will see property prices continue to either come off or to be flat, but longer term I think that we will see that property prices will go up and grow, partly because of things that always stable out, number one. Number two, overseas investment will drive property prices up.
So if we've got somebody that is looking to enter the marketplace in 2026, in terms of Roma's view on an ideal client, what does that look like?
Yeah, we know exactly what a Roma customer looks like. And essentially, we have what we call the Roma personas. Okay, so Roma persona number one is a what we call a blue collar property professional. So that is somebody that's a chippy tradesman. Yeah, thank you. So exactly. And those people are completely unsupported in the market, certainly for lending products. We see that absolutely Roma is here to be their lending partner and help them grow their businesses.
I started out as a tradesman. So I started out as a painter and decorator, retrained as a plumbing and heating engineer. In terms of what I see as common investor problems, managing trades is right up there.
Yep.
So and the trades are actually, they can turn the projects around if they're motivated to do so with a lender like Roma that are supplying them with a facility to do it and the support as well. I think, that's a good target market to capitalise on.
100%. And if I think about how we've seen our customer profile change over the past 2.5 years, as base rate went up, so the second Roma persona, which is the high earning professionals in another field, so doctor, dentist, lawyer, pilot, surgeon, finance director, property, an IT guy, whatever, who's high earning, wants to create wealth through property. There's been less of those people and more of the tradespeople coming back into the market to do projects, because they know they can buy materials better, they know they can buy labour better, and they will also rinse and repeat.
And they're able to do that.
And they're able to do that. And so, we've seen that the other one has come out of the market. The third persona, which has done well for us, is the white collar property professional. So architect, QS, somebody involved in property that's not on the tools, but knows people that are on the tools and can do work for them. So they've been pretty flat, but it's definitely the tradesperson. We've seen a massive growth in tradespeople doing, borrowing from us as they've looked to buy, because again, they can buy better.
Well, and as well, build costs have gone up exponentially over the sort of past few
Absolutely.
years. So it's priced some of the people out of the market,
Yep.
and the others that are able to buy correctly in terms and source materials and
Yep.
do the works at a lower rate than they would do for your other personas.
Yep.
That's why, reasonably you've seen that
Yep.
persona become more of a prolific borrower.
And we've got all sorts of initiatives to support those people in the market. And they are also, they live, eat, sleep and breathe their projects because they're doing a lot of the work themselves. It's doesn't just have to work on a spreadsheet, it's got to work in real life as well.
So if an investor is thinking about how do they position themselves well in 2026 so that that lenders like yourself want to work with them, what's the one thing that an investor should focus on so that they become a more attractive client to lenders like yourself?
I think it's all about buying well. Like every business, if you buy well, you can sell well. Don't rush into the first project that you see. Do your research properly. Know the market that you're going into. So we always say that it's very important that whatever product you're creating at the end is going into a liquid market. So, for example, if you're, in Manchester, for example, if you are doing a project in Moston, you'll put a different kitchen in from if you're doing a project in Mottram. Okay, so make sure that the project that, again, sometimes if you're doing it, you can often think to yourself, you know what, I could live here. Don't think like that. You've got to think of it as if making sure that the product that you are creating is going into a market that's liquid for the area that you're in.
As we covered on the episode we did with Adam, it's got to be a business.
Absolutely, it's a business. You buy well, you sell well. Buy well, you renovate well, you sell well, rent well. Don't make it a labour of love. You do that on your own home, but you don't do that when it's a business.
Absolutely. So thank you for giving us your overview. Is there anything that you'd like to finish with on the podcast today?
Yeah, I think I would just say to people that, there's a whole load of noise out there, but I don't think there's ever been a more exciting time to be in the property space than there is right now.
Brilliant. So that's it for us today. We're just going to cover our last two sponsors and then we're going to wrap it up.
Yeah, so you've heard a lot of great wisdom and advice today. And if you want another source of great wisdom and advice, Blue Bricks Magazine, through your letterbox every single month. You don't need to scroll through hundreds of web pages or emails. You just get the best information from the market so that you can make smart decisions as a smart investor.
And I believe Scott was on the front cover of the last issue, weren't you? Or was
yeah.
It, yeah, you were?
I've got a lot of time for Sam Cook and for Vicky as well. I think they're great people.
And I may or may not be doing a column in there as well myself in the next episode. So next issue even. And our final sponsor is the Optimized Entrepreneur. They are helping entrepreneurs optimize their health, so therefore it optimizes their performance. I've been working with those guys for around about 13 months now, seeing huge benefits, less porky, less brain fog, less lethargy, more energy.
More James Rogers.
More James Rogers. More ability to eat curry. So thank you very much for joining us on this episode. Scott Marshall from Roma Finance's views for 2026, and of course, explanations and descriptions of their full product offerings. So we hope you've enjoyed it. Please get yourself along to a local property and poppadoms meeting, and remember that our first national event takes place on Saturday the 31st of January at the Village Hotel in Solihull. So we hope to see you there.
We'll see you then. See you on the next one.